Hi, my name is Tana Gilday, and I'm a principal and financial advisor with Homrich Berg. I work with a lot of women going through the divorce process or the loss of a spouse, and I know what a difficult and trying time this can be. It's especially hard because in addition to the emotional aspects, we have the practical aspects of processes and administrative tasks and paperwork that has to be completed. Divorce settlements that have to be negotiated and reviewed. So I wanted to embark on a series that I call A Great Question Can Make All the Difference. So today, I want you to think about the question, what is the after-tax value of the assets that I'm going to receive, and when and how am I using those assets? So as we think about the assets that we have, things like a car and a bed and a house, we know how and when we're going to use those. Those are very easy. We don't think about that. But when we get to financial assets, it gets a little muddier in terms of really knowing consciously and intentionally thinking about the asset, when and how we're going to use it, what the purpose is, and importantly, what the after-tax value is. So I'm going to give you an example of 3 potential assets that you might see in a divorce settlement, and we'll talk about and consider what is the after-tax value of those assets. So the first is $250,000 in a checking or savings account in your name. The second is $250,000 in an IRA in your name, individual retirement account. And the third is $250,000 in a brokerage account that's invested in stocks, bonds, mutual funds. So as we look at those, the checking or savings account is pretty easy. We've all dealt with that. $1 in that account is $1 that we can use to meet our current needs. Putting a deposit on a house, paying rent, paying the mortgage, car payments, buying groceries, all of those things that's usable dollar for dollar if it's in a checking account or savings account in our name. When you look at the IRA, however, we have to understand the nature of a retirement account that is tax deferred. That means when the money goes into that account, it is not subject to income tax. So any activity, it's tax deferred. Anything that happens in that account, we get interest, we earn a dividend, we buy and sell the investments. All of that is behind the tax wall. We are not paying tax on that in our current year's tax return. It's just growing, hopefully growing, tax deferred until we access that, hopefully in our retirement. The important thing to remember is while the activity now is not incurring taxes, every dollar we take out goes over the tax wall and is subject to income tax. So that's federal income tax as well as state income tax if you live in a state that has an income tax. So you have to consider what are the tax rates that I'm going to be subject to on my ordinary income. I get a job, I get a paycheck, that goes on my tax return. I take $1 out of my IRA, that goes on my tax return. That's all ordinary income, which is the brackets. If you Google 2023 tax brackets, you can see what those rates are. They start low, and as you make more and more money, the rate that you pay on your income increases. So $1 coming out of an IRA is not a spendable dollar because we've got to pay tax. That's what's meant by the after-tax value if you have to take it out of the IRA. The other important thing about the IRA is until you are 59 and a half, any dollars that you take out could be subject to a 10% penalty for early withdrawal. The tax code has drawn a line in the sand that says once you're 59 and a half, you're not subject to the 10% penalty. If you're under it, you may be. There are certain exceptions to that penalty rule. So definitely talk to your advisors, your tax advisor, to see if you qualify for one of those exceptions if you need to access the IRA. But keep in mind, the after-tax value of $1 coming out is not one spendable dollar, regardless of the penalty. It's always going to be subject to income tax. The third account is $250,000 in a brokerage account in your name. So that is not a tax-deferred account. That is subject to income tax on any of the income coming in the account. So as you earn interest, as you're paid dividends, as you buy and sell stocks and mutual funds, all of that activity is going to come through and show up on your tax return every year. Importantly, if you need to use those assets to buy something today, we have to consider what happens when we sell an investment in that type of account. We have to calculate the capital gain, and that is how much did you buy it for and how much did you sell it for. Hopefully it's more that you sold it for than you bought it for, and that difference is a capital gain. If you sold it for less than you bought it for, you would have a capital loss. But let's assume we've got capital gains in there. The other important thing is how long did you hold the asset? If I buy an asset today and sell it next week, that's a short-term capital gain. And in fact, anytime within the first year, if I sell it, it's a short-term capital gain. And those short-term capital gains are considered ordinary income. So that goes on my tax return just like my paycheck and taking $1 out of the IRA. However, if I've held it for longer than 1 year, I now have a long-term capital gain, and those get more favorable tax rates, at least in 2023. So for most, it's going to be a 15% federal rate. If you're in those high brackets, $400,000 or $500,000 of taxable income, you would be subject to 20%. So definitely talk to your tax advisor and see what rate would apply in your situation, especially as you move forward as a single person. But be aware, when you sell those securities in there, that portion that's gained is not dollar for dollar spendable. You're going to have to pay tax on that, so you're going to owe some as you have that capital gain. So to recap, the cash in the checking account, dollar for dollar, available for current needs. The IRA is going to be subject to federal and state income tax for every dollar you take out. And the investment account, when you sell those investments, there is the potential there for capital gain or loss, and you may not have the full amount available to use because you've got to pay some tax on that gain. Now, with that said, that doesn't mean that, I only want to get cash in a checking account. Each of those assets has a time and a place, which leads us to the second part of the question. When and how am I using those assets? What's their purpose? So we think about the IRA or a 401k, they behave the same. Is ultimately the purpose is to take care of us in retirement. So ideally, we want that type of asset to be growing and building our wealth until we hit that time where we stop working and now we're in retirement and we're using that type of asset in our retirement because our paycheck has turned off. So that's a great asset for that. The marketable securities, another great asset for building long-term wealth and financial security. We love getting that interest, getting those dividends, seeing that hopefully grow over time as you add to it, because that account you can add to it as you please. It's not subject to limitations like the IRA is in terms of putting more money in. So we can build that long-term wealth. And if there's an emergency and we do have to tap it, we can get to that without a penalty. We just have to always remember we're going to have some tax in there potentially if our investments have been growing over time. So all three are valuable. All three have a purpose, a time, a plan, a role in your long-term financial plan. You just want to be sure that you ask the great question, what is the after-tax value of the assets I'm receiving? And understand when and how you are going to use those assets. I hope you found this information helpful. I wish you and your family the absolute best as you navigate through this process. I hope you ask your team lots of great questions and get lots of good information that you can use to move forward as a single person on this next phase of your life. As you do so, if you find that a new financial advisor might be a good fit for your situation, please take a look at our website at homrichberg.com. On the site, you can see the types of clients that we work with and how we serve those clients. If it seems like a good fit for you financially, I'd be happy to sit down and talk to you about your long-term goals and plans and find an advisor who's right for you. Best of luck, take care, and tune in to the next episode in our series.